Good morning. It's Jonathan Brathwaite here again on the international arbitrage. And so today I just wanted to say a few things on the group captive insurance companies. A group captive insurance company is kind of just what it sounds like. It's basically a group of owners of international businesses that come together and decide to set up a captive insurance company because their annual insurance premiums might be 300,000 each, but 10 owners could come together and form a group captive insurance company, which means that the costs of running the captive insurance company are shared amongst 10 persons, 10 shareholders. A captive manager or who's a regulated entity and a trust could be used to hold a captive insurance company held by a trustee, so that basically there's kind of some independence, and service providers will run captive insurance companies in line with the business plan and the numbers and what have you. So there are many a group captive insurance companies in operation around the world. Barbados is just one jurisdiction where that happens. There are many other jurisdictions, but you don't have to use Barbados. There are other jurisdictions, some in the U.S., some in elsewhere in the Caribbean. So you can take your pick. But one of the things I'll say, when group captive insurance is ideal for, or captive insurance, self-insurance is ideal for owner managers of mining and oil and gas companies that are not within the U.S. when you're trying to raise money from U.S. investors. Here at Mithril, we talk about, we advise our clients to set up regulated international private investment funds with a regulated fund manager, because U.S. investors who are, see international investments in owner managed businesses that are not regulated institutions as highly risky. The U.S. high net worth persons also tend to have their wealth held in U.S. private banks that have compliance departments that view small international operations as high compliance risk, and they view countries in Latin America and Africa as extremely high risk, high compliance risk, because those countries have devaluing currencies and political risk and other things. But as I was saying, and as many of my clients and my people in my world know, capitalism is about high risk and high return. So if you live in a high risk country, your opportunities are high risk, and so your returns are high risk as well. And so many talented entrepreneurs in many countries in Africa and Latin America are able to overcome problems and get operations and business going despite all the risks, and the profits they generate are small compared to large global multinational companies, but they're significant to international families. We say less than $100 million is the typical profile. And so if you're trying to raise money in the U.S. from U.S. investors, you need to do things that reduce the perception of risk, reduce compliance risk. And using a regulated fund manager with an international private investment fund is one way to do that, to reduce risk for U.S. investors. But still, even doing that, there remains risk, and so the other thing you can do is it can set up a captive insurance company. And a captive insurance company can basically pay insurance premiums to an insurance company that is owned by the project, and the insurance premiums are paid out of profits that are or funds that are generated in the local operating jurisdiction. And so the captive insurance company is going to be based somewhere like Barbados, which is where I am at the moment. And then the shareholders of the captive insurance company would basically be able to get dividends as long as there are profits in the captive insurance company and there are no claims. And so what you could do is you could increase the amount of risks that are insured by your captive insurance company, and justify and work with a broker to make sure properly, an actuary, to properly structure an insurance policy and insurance premiums that are tax deductible in your local operational jurisdiction, and then paid to your captive insurance company. Now, your shares, so if you're a family, an international family, and you're building a legacy, and you want to raise less, less than $100 million, say $40 million, by having a captive insurance company, you reduce the risk, the perception of risk to U.S. investors. Now, what you can do for some of your largest investors is you can give them you can give them shares in a captive insurance company so that they're receiving dividends immediately from a separate source, related to the project economically, but separate from it. Captive insurance companies custody their funds in regulated financial institutions. So a captive insurance company will custody its funds and generate investment income in Canada or the U.S. By booking those assets with one of the Canadian banks in Barbados. So this is highly comforting to U.S. investors. So you can give investors shares in your captive insurance company, some. The other thing that families with owner-managed businesses can do is, when you're building a legacy for your children, for your wife and your family, and you need to keep them protected, it's a closely held business. You can't just bring anyone into that set. Your children might be young, and it's years until you know whether they're going to be, heavily involved in the business or not. So what you can do is actually, instead of giving your key employees shares in the actual business, you can give them shares in your captive insurance company, which is very much tied economically to your business. Now, as I've said before, most governments allow insurance payments, allow companies to access U.S. dollars or hard currency for payment of insurance premiums. Most countries and governments understand that insurance is a global market, and there's a need to enable economically their businesses in their country to access insurance. So this is why having an international captive insurance company is actually a very viable approach to things. And so then what you do is, by giving your key employees who are based in Latin America or Africa shares in the captive insurance company, they know when they receive dividends, they're receiving dividends in hard currency. So you may be paying them at home in the local operating jurisdiction in local currency, but like you, they would have a desire to accumulate wealth and options in U.S. dollars. I mean, I don't know, half or more of Latin America banks in Miami, they set up and accumulate funds and assets over time in banks in South Florida. And so by giving your key employees shares in the captive insurance company, you're motivating them, you're giving them a lot of what they want. It's incentive, it's hard currency, it's long-term wealth management. But what you're also able to do now is you're able to preserve the operational company and the core assets for your family and family members. It also, in closely held companies, the other benefit is if you keep it within the family, it makes things simpler, reduces the potential for conflict. And if you have young children, you protect them from matters of conflict until such time as they're old enough to decide, what they want to do for themselves. So these are a lot of the things that international families have to think of. And as I said in another video, the captive insurance people aren't targeting or aren't trying to speak to a lot of small owner-managed companies that have insurance premiums of $500,000 a year or more. They're not, they're not tracking you down. So that's probably why a lot of you don't know about captive insurance. But captive insurance companies can not only benefit your family, they can basically greatly enhance your ability to raise capital from U.S. investors. And this is why you should give it a look. All right, that's it on the international arbitrage today. I think more of my next couple of videos will be on South Dakota trusts. All right, cheers for now. Bye.